Welcome back to the Deep Dive. We often talk about the big, flashy parts of the economy, but today we're plunging into something absolutely essential, yet often overlooked. Seriously, just take a second to think about it. Every single one of us, every home, every business, we all generate waste, like constantly. And some company has to deal with it. It's this critical, almost invisible service that keeps everything running. So today, we're pulling back the curtain on one of the real giants in this space, Republic Services, Inc. The ticker is RSG. And our mission for this deep dive is really to unpack what makes this company tick. We're looking at its strengths, which seem pretty durable, but also some, surprising challenges and where they're trying to head strategically. We've sifted through a whole stack of sources for you, everything from, detailed business analyses and earnings reports, right down to what actual customers and employees are saying. Our goal is to pull out most important insights, maybe some surprising facts you haven't heard. Think of this as your shortcut to getting really informed about a company playing a crucial, often hidden role in our infrastructure. Ready? Okay, let's dive in. So waste management, it sounds pretty basic, right? Just dealing with trash. But what's really fascinating is how a company doing this builds such an enduring, almost fortress-like business. Let's start right there. What is their fundamental business model, and why is it so durable?
It's true, yeah. At its core, Republic Services' model is, simple but incredibly strong. They provide essential environmental services. That means primarily collecting, transferring, disposing of, and recycling non-hazardous solid waste. And they do this for a huge client base. We're talking 13 million residential, commercial, and industrial customers across North America. That scale is really key because it gives them this remarkably predictable revenue stream. I mean, people and businesses, they just keep generating waste, right? It doesn't really stop.
Right, it's constant. And you've been from vertical integration before we started. Can you break that down? Like, what does that mean in practice, and how does it give them an edge?
Absolutely. Think of it like they control the whole journey of waste. It literally starts at your curb with their massive fleet, something like 17,000 trucks. From there, the waste goes through their own transfer stations, which basically consolidate it, make it more efficient to handle. And then finally, it ends up either in their own landfills for disposal or at their recycling centers. So this vertical integration, it lets them capture value at different steps and gives them significant control over their operating costs.
Okay, so they own the trucks, the transfer stations, and the landfills.
Pretty much the whole chain for a lot of their volume. And if you look at where the money comes from, it's mostly service fees for collection. That's the real cash cow. For example, just looking at Q1 2025 numbers, collection revenue was huge, like $2.7 billion. That's almost 70% of their total revenue. But, and this is important, they're also strategically growing what they call environmental solutions. That brought in around $449 million that same quarter, about 11% of the total. That's definitely an area they're focusing on for growth.
Almost 70% from collection. That's massive. So why is this model so resistant to economic downturns? It sounds almost like a utility company.
You're absolutely spot on. It shares that characteristic with utilities because waste management is, non-discretionary. Society just produces waste by existing, by doing business. Someone has to manage it. That makes the business incredibly recession resilient. You might see industrial or construction waste volumes fluctuate a bit with the economy, sure. But that baseline residential and commercial waste, that provides this incredibly stable foundation for revenue. But here's the kicker, and this is where it gets maybe even better than a regulated utility. Republic Services has significant pricing autonomy.
Okay. So unlike my electric company, they don't need a commission. It's okay to raise rates.
Exactly. They can often implement price increases, add surcharges, sometimes just with a notice on the invoice. This lets them price ahead of inflation, not just react to it. That's a really powerful tool for long-term value creation.
Okay, that is interesting. So if the core business is that stable and they have pricing power, what creates their competitive advantage, their economic moat, as we call it? Is it really that strong?
Oh, it's strong. It's pretty close to impenetrable, actually. RSG has this wide economic moat, like a fortress, really built on two main pillars: intangible assets and cost advantages.
Okay, let's unpack those intangible assets first.
Right. The biggest one, by far, is their ownership of landfill operating permits. Getting approval for a new landfill today, it's monumentally difficult. You're navigating this maze of federal, state, local regulations. And then you've got the whole, not in my backyard, the NIMBY factor. Communities just don't want new landfills nearby.
Understandable, yeah.
So this combination of regulation and social opposition creates these huge barriers to entry. It means RSG's existing network of around 207 active landfills, including some massive ones. These are incredibly scarce and practically irreplaceable assets. Think of them like gold mines, but new gold mines are almost impossible to find or get permits for anymore.
Okay, so the landfills are key. What's the second pillar? Cost advantages.
Yes, cost advantages. These come from route density and that vertical integration we talked about.
Yeah.
Waste collection is fundamentally a logistics game, right? Efficiency drives profit. So if RSG can service a lot of customers close together on one route, it dramatically lowers their cost per pickup, less fuel, less labor time, less wear and tear on the trucks. That density gives them a real edge over smaller players.
And the vertical integration plays in here too.
Absolutely. Because they own the final destination, the landfill, they internalize those disposal costs. A smaller hauler who doesn't own a landfill has to pay tipping fees to use one. And often, they're paying those fees to Republic Services.
Huh. So RSG gets them coming and going, potentially.
In a way, yeah. It creates this structural advantage. Those landfills really are the strategic crown jewels. They anchor the whole system and protect their collection and transfer businesses. It's a virtuous cycle.
That makes perfect sense. So with a moat like that, can you give us a real-world example? How do we actually see this pricing power in action?
Yeah, definitely. The clearest sign is just how consistently they can raise prices. Their service agreements literally say they reserve the right to increase rates and add fees. And they do it. Look at Q4 2024. They reported a core price increase of 7.3% in related business revenue. And get this, in their open market segment, it was 9.1%.
Wow, 9.1%. Even if volumes weren't growing much.
Exactly. Even when volumes were flat or maybe even down slightly, that ability to push through price increases, often well above inflation, even without booming volume, that's the clearest signal you can get of a powerful moat protecting their profits. And this moat seems stable, maybe even widening. Getting new landfills permitted isn't getting any easier, that's for sure. Makes their existing ones more valuable every year. Plus, management is actively trying to widen it further. They're moving into more complex, capital-heavy, regulated areas like that U.S. Ecology acquisition for hazardous waste and these big investments in polymer centers and renewable natural gas.
Okay, so on paper, the business looks incredibly strong. But, the scuttlebutt. What do actual customers and employees say? Is it all smooth sailing, or are there, patterns you noticed?
This is where it gets really fascinating, actually, because when you dig into customer and employee feedback, you see this really sharp divide. It's striking.
A divide, how so?
Well, for customers, it's like a tale of two completely different markets. Residential customers. You go on sites like the Better Business Bureau, Angie, Reddit. You see a lot of frustration. It's consistent stuff. Missed pickups, bills that are hard to understand, Byzantine billing, someone called it unexpected fees, and really poor customer service experiences. Long hold times, unhelpful answers.
Ouch. Any numbers on that?
Yeah, the BBB alone had something like over 2,600 complaints in just 3 years. And you see phrases like worst customer service ever pop up again and again. It's pretty rough.
Okay, but what about the other side of the divide?
Right. Commercial customers. Generally, very positive experiences. Businesses often praise their dedicated account managers. They talk about seamless service, operational reliability. We found testimonials calling the service top-notch, recommending RSG for commercial accounts.
Weird. Why is such a big difference?
Well, think about the market structure. In the residential market, RSG often has exclusive contracts with cities or operates in a duopoly. Homeowners don't have many, if any, alternatives. So frankly, the incentive to provide absolutely stellar service isn't as high.
Because where else are they going to go?
Exactly. But the commercial market, it's more competitive. Businesses have more choices. The accounts are larger. So RSG needs to provide a higher level of service to keep those customers happy and retain them. So it's almost like the sometimes poor residential service isn't really a bug. It's kind of a feature of their market dominance there. It doesn't seem to threaten their overall stability.
Interesting perspective. And what about employees? Is it a similar split?
The very similar polarization, yeah.
Yeah.
Officially. The company looks great. They're certified as a great place to work. Something like 82% of surveyed employees endorse it. They talk about a welcoming culture, pride in their mission, sustainability focus.
Sounds good.
But then you look at anonymous forums like Reddit or Comparably. Comparably gives their culture a D+ rating, which is not great. And it seems to be mostly the frontline operational staff, the drivers, the technicians. They often complain about mediocre pay, really grueling hours, mandatory overtime, sometimes equipment that's not well maintained.
So a disconnect between corporate and the frontline.
It suggests that, yeah, a potential cultural divide between maybe the management track folks engaged with the big strategy and the workforce dealing with the day-to-day operational grind.
Okay, that's a really stark contrast, both with customers and internally. It seems like that strong market position might actually counterintuitively reduce the need for top-tier residential service. But looking ahead, does this split sentiment, especially with the frontline workers, pose a real, meaningful long-term operational risk?
I think it absolutely could, yes. It's maybe not an immediate five-alarm fire, but high turnover, low morale among those essential frontline workers. Over the long term, that can definitely impact service quality, safety records, and ultimately their efficiency. It's certainly something worth keeping an eye on.
Got it. So with all these dynamics, the strong moat, the pricing power, but also these service and employee sentiment issues, what does it all say about the leadership? Is the management team truly owner-oriented? Are they steering the ship well?
Yeah, the evidence really points towards a strong and rational leadership team, especially under the current CEO, John Vander. He took over in mid-2021, but he's a company veteran, was COO, president, came from McKinsey originally. His approach seems very much focused on the long term, very owner-oriented. He doesn't see RSG as just a slow-growth utility. He sees it as this recession-resilient engine with a lot of runway left for profitable growth.
How does that come across?
Well, he talks constantly about creating long-term value. And he has this quote I found interesting. I'm paraphrasing slightly, but he said something like, "People say we're just a landfill company making all our money there. Nonsense. Landfills don't pay me. Customers pay us."
Focusing on the customer, not just the asset.
Exactly. It zeroes in on where the value actually comes from. And strategically, he's clearly trying to evolve the company beyond just being a garbage company.
Yes.
He's pushing into these broader environmental services like sustainability, hazardous waste areas that are adjacent, widen the moat, and potentially offer higher margins and growth.
Okay, so that's the philosophy. How are they actually using their cash to back this up? What does their capital allocation look like?
It looks pretty disciplined and balanced, hitting three main areas. First, they reinvest a lot back into the core business. That's maintenance, but also funding new growth projects like building out that Polymer Center network or the Lightning Renewables JV for renewable natural gas. Second, accretive M&A acquisitions. The waste industry is still fragmented, so buying smaller players is a key growth strategy. They do lots of tuck-in deals, but also made that big $2.2 billion splash buying U.S. Ecology in 2022.
Was that a good deal?
Well, they say it was immediately accretive to earnings and cash flow, which means it started adding to profits and cash right out of the gate. And it significantly boosted their position in that higher margin environmental solutions space. And third, they're committed to shareholder returns. They have a steadily growing dividend, and they buy back shares opportunistically.
So reinvesting, acquiring, and returning cash to shareholders.
Right, a balanced approach. In 2024, for instance, they generated almost $4 billion in cash from operations, and they returned over $1.1 billion to shareholders through dividends and buybacks while still funding growth and acquisitions. Seems sensible.
And one more thing. The CEO has a requirement to hold company stock worth 5 times his base salary. That helps align his interests with long-term shareholders, which is always a good sign, you know?
Yeah, definitely skin in the game. Okay, so strong leadership, disciplined capital use. How strong is the actual financial position? Do they have what you'd call a financial fortress?
I'd say they absolutely do. Republic Services is just a really reliable earnings machine. You look back over the last decade plus, you see steady revenue growth and, importantly, consistently expanding margins.
Margins are growing, even as they get bigger.
Yep. It's not just revenue growth. Their profitability is improving. That's a direct result of that essential service model, the strong moat allowing pricing power, and just disciplined execution. Their adjusted EBITDA margins, for example, grew by 140 basis points in 2024 alone. That's solid evidence of their strength. And that margin expansion is key because it means profits can grow faster than revenue, which is really what drives shareholder value over time.
Okay, what about some key ratios? How do they stack up? Well, look at ROIC, return on invested capital. It consistently exceeds their cost of capital, their WACC. And that positive spread between ROIC and WACC has actually been widening lately.
So for every dollar they invest, they're earning back more than it cost them to get that dollar.
Precisely. That's the hallmark of a high-quality, value-creating business. For a capital-intensive industry like this, their high single-digit ROIC trending up is quite good. They're also fantastic cash generators. They explicitly target converting over 40% of their EBITDA into free cash flow. They hit almost 44% in 2024.
And that free cash flow funds everything.
It comfortably funds all those priorities we talked about: reinvestment, acquisitions, dividends, buybacks, without straining the balance sheet. And speaking of the balance sheet, it's very solid, prudent, conservative. Their net debt to adjusted EBITDA ratio was at a healthy 2.5x in 2024. They have investment-grade credit ratings across the board. That gives them safety and ensures they can borrow cheaply for future growth if needed. Financial fortress? Yeah, I think that fits.
Okay, so we've established it's a high-quality business, strong moat, good management, solid financials. Now, the million-dollar question for anyone listening, is the price right? Does the current market valuation offer an attractive entry point?
The big question.
Yeah.
And as of mid-2025, the short answer is the valuation looks pretty demanding. It's elevated.
How so? What are the numbers saying?
Well, if you look at their trailing 12-month price-to-earnings ratio, the PE, it's sitting around 37.1x. And their price-to-free cash flow is also quite high, about 32.7x.
And how does that compare historically?
That's the key comparison. The current PE of around 37x, that's substantially higher than its 5-year average, which is closer to 31x, and even further from its 10-year average of about 28x. In fact, the stock is trading at or near its highest valuation multiples in the last 10 years.
So the market definitely knows this is a good company.
Exactly. The crucial judgment here is that it's a demanding entry point. Republic Services is, without doubt, a wonderful company, but the market seems fully aware of that quality. This premium valuation suggests that a lot of future success is already baked into the stock price, leaving maybe a thin margin of safety for new investors today.
So maybe the price is fair, given the quality, but not necessarily attractive, kind of like buying a luxury good at full retail.
That's a good way to put it, yeah. An investment now really requires a high degree of confidence that they can meet or even beat these already lofty market expectations. It's got a bit of a sticker shock.
Makes sense. So if the price is demanding, what are the main growth engines the market is banking on? Where is future earnings growth supposed to come from?
Right. It's really about their strategic transformation into this more diversified environmental services leader. It goes beyond just the steady, maybe GDP plus growth of the traditional trash business. It's centered on two big pushes.
Okay, what are they?
First is environmental solutions. That U.S. ecology acquisition really gave them a strong platform in the industrial and hazardous waste market. That market's big, maybe $35 billion and fragmented. So the idea is they can deepen relationships with big industrial clients, offer them more services, cross-sell, and grow by consolidating that market further.
Okay, environmental solutions. What's the second one?
Sustainability innovation. This is where they're investing heavily to create value from the waste stream itself. Think of their polymer centers. The goal is to take mixed plastics from recycling and turn them into high-grade RPET flake, which is valuable stuff for making new packaging.
So turning trash into treasure, literally.
Blind them, yeah. And at the same time, their Lightning Renewables venture with BP is focused on capturing landfill gas and converting it into renewable natural gas, or RNG. That's another valuable commodity. These aren't just, feel-good environmental projects. They're designed to be profitable new business lines that plug RSG into the whole circular economy idea.
Okay, so that's the growth story. But even with a durable model and this future vision, what are the real permanent risks? What could actually damage their earning power long term? Yeah,
despite the moat, there are definitely long-term risks. One is always technological disruption. Imagine some breakthrough, maybe in materials science or manufacturing, that just drastically cuts down the amount of waste generated in the first place.
Less trash means less business.
Right. It could shrink their whole addressable market. Another risk is adverse regulatory change. Right now, regulations help create their moat, especially around landfills. But what if there's a big political or social shift? Maybe a really aggressive push to phase out landfills entirely, favoring alternatives that might not be as economical or proven. That could seriously devalue RSG's key assets.
Okay, technology and regulation. Anything else?
The other big one is just a major capital allocation mistake. Their growth strategy relies a lot on big M&A deals like U.S. Ecology and these really capital-intensive new ventures like the Polymer centers and RNG plants. If they make a misstep, maybe overpay hugely for an acquisition, or if these big sustainability investments just don't deliver the returns they expect, that could destroy a lot of shareholder value, Big bets carry big risks if they go wrong.
Makes sense.
Yeah.
Okay, let's try to connect this all to the bigger picture. What's the general market consensus on Republic services right now? And maybe more interestingly, where might a second-level thinker see something different?
Well, the market consensus is pretty clear, I think. It sees RSG as a premier company, wide moat, recession resilient, excellent management, consistent performer. You see that reflected in analyst ratings, mostly positive, like moderate buy. But their price targets often suggest only modest upside from current levels because they acknowledge that premium valuation we talked about. So consensus is great company, but maybe fully priced.
Okay, so where's the potential contrarian angle, the second-level thought?
The potential contrarian view, I think, lies in maybe underestimating the long-term significance and the nature of this transformation they're attempting. The market today seems to view the sustainability stuff, the environmental solutions, as sort of nice incremental additions to the core trash business, like a good waste company with a bit of a green tinge.
But you think there might be more to it?
A deeper analysis, or maybe a more forward-looking view, might see this as the beginning of something bigger. Maybe the genesis of a future leader in the actual circular economy. Think about it. They're taking waste streams, plastics, landfill gas, and turning them into valuable manufactured commodities, RPD, peak, RNG, punchin'. They're shifting from being just a service provider to potentially becoming a vertically integrated manufacturer of sustainable products.
That's a different kind of company.
It is. And if they pull it off, that could unlock higher, maybe more stable margins, open up totally new markets, and create stickier relationships with big corporate customers who have their own sustainability goals. So the second level thought is, maybe the current valuation looks high for a waste company, but perhaps it might look more reasonable 10 years from now if they successfully become this more complex, more valuable industrial sustainability leader. The market might be valuing the past, while the real value creation lies ahead.
That's a really interesting perspective. Okay, let's push that a bit further with a red team challenge. Let's actively try to poke holes in the optimistic case. How could paying today's premium price for Republic services turn out to be a major long-term mistake?
Okay, red team scenario. It becomes a mistake if those new growth engines, the polymer centers, the RNG facilities, just don't deliver. Maybe the technology doesn't scale as expected. Maybe the regulations change, making them less profitable. Maybe commodity prices for RPT or RNG collapse. Or maybe they just can't execute these complex projects efficiently. In that scenario, you've sunk billions in capital into projects that aren't earning a good return. That would drag down the company's overall ROIC.
Okay, so the new stuff disappoints. What else needs to go wrong?
At the same time, imagine the core solid waste business proves more brittle than everyone thinks. What if that technological disruption we talked about, serious waste reduction, happens faster? Or what if society and regulators really do turn aggressively against landfills quicker than anticipated? If the legacy cash cow starts to erode while the new growth bets fail to launch, well, that's a recipe for trouble.
So to really crystallize that challenge for our listeners, could paying a premium price for this wonderful company today, justified by the promise of this exciting new growth story, actually turn into a classic value trap if that growth engine just sputters out and the old reliable business starts to fade? It's definitely something to think about. How much are you willing to pay today for a company's future vision, especially when realizing that vision involves executing on really complex, capital-intensive new ventures? That's the question we'll leave you with for this deep dive.